Hello again, fellow BeachBum traders. Thank you for joining us for part one of our weekly trading game plan for the last week of March, March 27th through March 31st, where we'll talk about the impacts from the latest Fed interest rate hike. Hopefully, you were able to survive the initial impacts from the latest Fed interest rate hike and hopefully take some advantage of some of the initial impacts from the latest Fed interest rate hike. And we'll talk about additional strategies, trade ideas, etc., of how hopefully you'll be able to take advantage and also survive the impacts from the latest Fed interest rate hike, as well as the ongoing collapse of the banking system. And we'll talk about strategies for how to deal with impacts from the ongoing bank collapse as well. So stick around to the end. We'll talk about those strategies, trade ideas, etc., for dealing with impacts from the latest Fed interest rate hike, as well as the impacts from the global banking system collapse, as we're seeing that. Welcome, MD, the Ricky Khan. Thank you for joining us today. Hope you're doing well. So let's get started. Here's our notes, our Google document with our notes for part one of our weekly trading game plan for this week. Our notes are publicly accessible. You should be able to find a link to this Google document for our notes for our weekly trading game plan in the description box below. Our notes contain links to bonus videos, links to all the tools that we're going to use to do our market analysis, our strategies, etc. So you can refer back to them as well. We store the notes for our weekly trading game plans in a publicly accessible Google Drive folder. So again, you can find the link to this Google Drive folder in the description box below, so you can refer to notes from our previous weekly trading game plans, as well as to refer back to these notes in the future. So we hope that all helps. So I'm going to quickly try to go through the market from last week, and so we can get to our strategy, have time to talk about strategizing impacts from the latest Fed interest rate hike, the bank collapse, etc. Good morning, Johnny Trades. Thank you for joining us. So I jumped over to FinViz. We could see how the markets ended up on Friday. Again, the markets were pretty volatile all week with the Fed interest rate decision, the economic data, the ongoing bank collapse, etc. So we saw Friday, the markets kind of started out down and eventually eked out a small gain towards the end of the day. But we can see under the covers, advancers, decliners was pretty split. Very few new highs, many more new lows. The vast majority of stocks are still below their 50-day moving average, so it's almost 80-20 below, and about 65-35 below their 200-day. So, very bearish under the covers, although, again, it did eke out a little bullish signal towards the end. We could see the NASDAQ was positive and mostly buoyed up by the FANG stocks and NVIDIA, and we'll talk about, again, we talked about this last week, the flight to safety into the FANG stocks, the megatech stocks, and a couple semiconductors like NVIDIA and AMD. So we look at some of the most recent news: Black Swan funds, hedging, commercial real estate's in trouble. We'll talk about that as well, probably more so tomorrow and also in the sectors. Despite bank jitters, so again, we got a positive result on Friday, even with all the bank collapse issues. Bank of America says sell stocks rather than buy, as after the last rate hike. So that's what Bank of America says. So very quick look at the futures. We'll dig in more depth in a minute. We saw oil break down below 70. As we'll see, 70 is now acting as a resistance. I'll talk about some of the news relative to oil. See natural gas. Again, the futures, we'll see it's kind of testing that bottom near 2. Hasn't quite broken. It's got a resistance at 3, a bottom at 2, and right now is kind of bouncing in that range. We saw a big run up in gold earlier. Again, heavy resistance at 2,000. So again, when we see the futures, we'll see that heavy resistance at 2,000, but it made a pretty steep run up into that resistance at 2,000. We can see here the indices futures are showing positive. A lot of volatility in foreign currencies. So the dollar did weaken some initially. with the bank collapsing, et cetera, the Fed interest rate decision, and we'll see the effect on various foreign currencies, and then we see this dramatic decline in the treasuries. Now, this is where, again, none of this is financial advice. I'll put our little, not financial advice banner up, as is none of our videos. This is all my opinion, my views, etc. And we're not financial advisors, and none of our content should be construed as financial advice. But in my humble opinion, this severe dip in the Treasury yields is very irrational, flight to safety, and having a lot to do with the bank collapse. And we'll talk about that in more detail, and where I expect this to correct itself in the future. So, welcome, Flip of the Shippa, Clifford, Mansley. Thank you for joining us. So we'll look at the indices, and we see a lot of volatility, a lot of chop, sitting, kind of on its 20-day and 50-day moving averages. We'll zoom out a little bit so we can get a better picture of the longer term trend. But as you can see, just pretty flat, very choppy, very volatile. So if we zoom out a little bit, we see, we got a little bit of a bounce off the bottom. Again, we'll talk about the Fed interest rate decision. It was pretty much as expected. There weren't any real major changes in policy in the comments that were made. I did capture a number of comments, and I'll share those with you as well. But the market said, yeah, okay, as expected, and so we're going to rally. So it attempted to rally, and again, it's been shaken up by this bank collapse news, etc. And again, we'll talk about that as well. Heavy resistance from this 50-week moving average. So again, I would expect more chop, more of the same. Again, we don't have another Fed interest rate decision till early May, as we'll see. So we're not going to get a whole lot of changes. In my humble opinion, again, none of this is financial advice, but I think the market activity will be dominated by what happens with the banking system and any further bank collapses, etc. So if we look at the Qs again, they wanted to rally tech, the flight into the mega caps, flight into the FANGs. So see the NASDAQ had a more positive recovery. It's sitting above its 50-week moving average. One could expect a little bit of a correction back down to that moving average, and then, more chop. We see broadening bars. So again, high volatility, high chop. Look at the Dow. Morning, Easy Mike, Walter Lyons. Thank you for joining us. Glad to see you as well. Hope you all are doing well. Hope you did well this week. So again, the Dow took a beating, and bounced. We had a little bit of a doji indecision, somewhat with a recovery, but it's sitting below its moving average. So we're getting some resistance. You can see it tried to breach that moving average, failed, got rejected, back down. There's pretty significant risk here. We've got some gap down here. So it looks like the Dow's, has some more risk in it. IWM and small caps, took a big dip the past couple weeks. Again, very indecision, very choppy. We got some downside still. It's below its previous low. So again, maybe go down and test that previous low again. Again, a lot of your small caps are going to be more sensitive to increasing rate hikes. They're also going to be sensitive to regional banking issues, etc. So again, more potential downside in the Russell. The VIX, so here's kind of interesting, is we got some volatility. We got a spike. We've been getting some elevated volatility on these bank collapses. It's kind of interesting. On Friday, I saw the VIX start to move up, and I hadn't heard the Deutsche Bank news yet. And I was wondering what the move was driving the VIX up into the low 20s, and then I heard the Deutsche Bank news. It's like, okay, yeah, that's. But we still haven't reached 30, so we're not seeing a massive amount of fear out in the market yet. It's just highly volatile, but the VIX is still hovering in the low 20s. So again, Not an enormous amount of fear yet, but highly volatile. The VIX is bouncing up and down between 20 and 25 or so. So we'll look at the group sectors, industries, etc. very quickly. And just a quick reminder, and I'm going to go over sector rotation in more detail, so I'm going to go through this pretty quickly right now. When we get to the strategies, we're going to talk about how to take advantage of sector rotation and some of the things I've been seeing in that area. But we have a number of videos on how to use this groups tab in FinViz in more detail. So again, I won't go into detail now. Again, Friday, we see this flight to safety. We see a recovery in real estate. I think that's a interesting positive trend. We've been talking about that real estate been beaten down. There's particular industries within real estate that I think are higher risk. And I think if we can get a differentiation in some of those industries within real estate, I think there's some opportunity there. Again, flight to safety, utilities, defensives, basic materials, which is gold, silver primarily. And then energy made a little bit of recovery, a little negative on technology, cyclical, etc. For the week, though, we see communication service technology, so higher risk areas, growth areas. So they tried to rotate into that area. And then on Friday, particularly with the banking issues, Deutsche Bank, etc., a new flight to safety. Again, real estate's pretty negative, so I think there's opportunity there. We see basic materials moving up. Again, I think that's a positive trend that we can take advantage of as well. And again, for the month, we saw real estate, energy, obviously financial is very negative, and again, basic materials. So I think there's some opportunities in those areas. Downside, in my humble opinion, they're going to continue to keep trying to run tech. I think, again, the FANGs are holding it up. The mega cap techs are holding it up. And if they start to break down, we'll see breakdowns in communication services and technology. Again, my humble opinion. So quickly look at the industries as well. I think this is interesting as well. And we're going to talk a lot more about sector rotation, industry differentiation, but you see now the REITs are starting to differentiate. They did try to, the office REITs were beaten down severely, and they tried to, rotate into that. That was positive, but I don't like office REITs. I don't like mortgage-backed REITs. I do like industrial REITs and other more diversified REITs, but you see all the number of REITs were positive, so positive rotation into real estate. Again, mortgage finance, I really don't like that. See some coal was positive. We've been talking the sector rotation in and out of coal, farm products, more tomorrow. I want to start talking about agriculture, potential future opportunities in farm products and agriculture in general. Again, gold, silver were very positive. Less so. I think there was some profit taking on Friday. Silver was very positive. We'll see that in the futures. Again, negative. Again, we've seen rotations in and out of uranium, and we'll talk about opportunities there. Friday, we saw probably just profit taking in semiconductors because it was pretty strong for the week. So again, rotations in and out of solar. Solar was down on Friday, but for the week, very strong. We've been talking about rotations in and out of solar, in and out of aluminum, in and out of steel. So again, you see these opportunities playing these sector rotations. And again, that's one of the major strategies I think we can take advantage of while, we are in that interim between Fed interest rate hikes, waiting for the global banking crisis to play itself out. There's plenty of opportunities playing sector rotations and rotations between these industries. So big negatives, hotel REITs, again, uranium was very negative, retail, and again, office REITs, residential REITs. So again, opportunities in sector rotation in some of these areas in real estate, I think. Just checking some of the comments. Glad to see you all chatting and helping each other out. That's the benefit of our community. REM and REC. Let me take a note. I may have those. I'll have to look tomorrow. Easy, Mike. I got that. I see you guys talking about biotech. We can talk about biotech as well probably tomorrow. We do have a number. We've got LabU, LabD, XBI, IBB, I think is the other one. Okay. If you guys want to look at biotech very quickly, I'll just take a look at it. So if we look at LabU is the 3X on biotech. I tend to trade biotech with LabU, LabD, so we can see biotech's way, quite a bit down. LabU's way down. We can look at XBI real quickly. And looks, downtrending, looks pretty negative on a week downtrending. So again, I don't like biotech in this environment. Higher interest rates, most biotechs lose money. A lot of them are zombies. I think a lot of them, they're either going to need to be acquired or they're going to go out of business. They're going to run out of cash. We'll talk about the cash environment tightening. Again, I don't like biotechs in this environment at all. So the IBB is a little stronger, but again, this is going to be, I think that's the NASDAQ version. So again, I think the IBB is being buoyed up by technology in general and just a flow of money into technology and probably not as specific into biotech. So semiconductors, biotech, sometimes they move with technology in general and sometimes they differentiate. So. Yeah, easy Mike saying AbbVie. There's specific biotech, specific drug companies that are doing well, and there may be opportunities in individual stocks within the sector. And again, that requires you to do your own due diligence, make sure, are they making money? What's their debt? What's their exposure to raising interest rates? What's their exposure to the bank issues, etc., venture capital? Again, it's complex, so you definitely need to do your due diligence. Okay, so let's talk about all the economic data we got. I'll talk about the Fed interest rate hike, the impacts, the comments from the Fed interest rate hikes. Just a quick reminder that as this data comes out, I'll bring up the economic calendar in investing.com. And typically, as soon as this data comes out, I try to copy it from investing.com and post it in the Surf the Markets Reports channel in our Discord. And we also have a feed from Market Watch Economy, so you'll get interpretations as well as additional market news in the Surf the Market Reports channel in our Discord. Our Discord's free to join. You can find a link to an invite to our Discord in the description box below, and I'll also put a reference up in the banner. So again, join our Discord. We can carry on these conversations we're having in the live chat, etc. also in our Discord. And again, you see plenty of news lately, layoffs, jobless claims, bank news. And again, as the economic data comes out, I typically screenshot it and post the raw data as well in this Surf the Markets channel as quickly as possible. So you can get that economic data as quickly as possible. So nothing much Monday, Tuesday. Wednesday, we got mortgages. You see at that time, mortgages were dropping a little bit. Again, the residential in general has been pretty much in a recession. going forward due to high mortgage rates. We saw crude oil inventories came out with a unexpected surplus. Again, we talked about oil prices going down below 70. We'll see how far they dipped. Refinery utilization, though, and was down much more than expected. Gasoline inventories down much more than expected. And then we got the Fed interest rate decision. So they hiked 25 basis points, as I expected, as most people came to eventually expect, although there's talk about a pause at zero. I didn't think that was rational given the inflationary data that we've seen, which is still high, but seems to be, slowly declining. So again, Fed interest rates now at 5%. We can see a longer term, 2.5, second year down to 3.1. So their year end is at 4.3. So again, they're projected to eventually come down, So some of the comments that came out of the press release, and I want to show you where you can get the actual notes from these press releases as well as the speeches, etc. But some that I noted out of the press release was some additional rate increases may be appropriate, so we may not be done with rate increases. They made no commitment to pause that they're done. They're telling you they might have to continue to raise, so we might get an additional raise in May and June, etc. Highly tentative to inflationary risk. We also heard comments from Bullard yesterday, as well as Powell. They're sticking to their 2% target, period. So they're not coming off 2%. So until inflation gets down to 2%, they're going to keep raising rates. It's just the rate of those rate increases may decrease. Inflation won't fall as quickly as expected this year. So they're saying inflation is not going to come down even as quickly as they had hoped or expected. So from the press conference, some of the notes that I took: inflation remains too high, labor market remains extremely tight, inflation pressures continue to run high. To get inflation down to 2%, we have a long way to go. They use this term now, policy firming. So not just interest rates, but quantitative tightening. We'll talk about the effect of the banking crisis on the quantitative tightening versus quantitative easing. Powell said Fed officials don't expect rate cuts this year. So he told you, even though the markets and the pundits and the talking heads are talking about in their pricing and rate cuts this year, he told you there aren't going to be rate cuts this year. Relative to the banking crisis, and I know there's this controversy between Powell's statements and Yellen's statements, but Powell said depositors should assume their deposits are safe. So he's just trying to keep people from being too fearful. He says you should assume, and you know what assume means. You should assume your deposits are safe, and rate cuts are not in their base case. So they're not going to cut this year, and they have no plan currently to cut. So let me click on this, grab a drink. I'll show you where you can actually get the notes. You can read these in more detail for yourself. So let me open this and then grab a drink. Okay, so you can see in investing.com, and I'll show you where that link is. So when they had their initial rate decision, etc., the press conference, if you click on any of these links there, or again, I've got it in the notes, it will take you to a site where you can actually then get at the latest release for their notes. So let's quickly look at, let's see, Thursday we got continuing jobless claims was pretty much in line, a little higher than expected, but initial was much lower. So again, the job market continues to be very resilient. They're not getting the jobless claims they expect. Job market's still strong, so the Fed can continue to be very aggressive, keep raising rates, etc. So again, very hawkish stance. Again, they're going to keep raising rates as long as the inflation stays high. They don't currently have any risk of high unemployment. Welcome to Ricky Khan. If I didn't say good morning to you already, glad to see you. Let's see if I missed anything in there. So home sales was a little better than expected. There was a slight dip in mortgage rates a couple months ago, and they estimate that dip, anybody that wanted to buy a house jumped on that, so they closed in the past month or so. Building permits is pretty much in line, although month on month was up a little bit. So starting new construction, so that looks like maybe that's recovering a little bit. Home sales in February was negative. Natural gas storage was negative, but less negative than expected. Again, natural gas is just kind of bouncing between 2 and 3 right now. Hasn't really trended strongly in either direction the past week. Durable goods orders was weak, so this bodes towards a potential recession. We'll talk about that as well. I commented on some of Bullard's, and you can see oil rigs up a little bit. So let's look at the economic data for next week. I think it's relatively quiet, although we'll have, Fed officials will start talking again. So that will cause some volatility depending on if they're a little more hawkish, a little more, dovish. Consumer confidence, mortgages, again, more Fed officials, typical oil, natural gas. Okay, GDP for quarter 4. So again, this is quarter 4 data, so it's lagging a bit. I would personally expect that quarter 4 is probably not too bad. The holiday season, I think people, spent the money they had, travel, buying presents, etc. So I don't expect, and you can see they're expecting positive, but declining. So again, positive GDP, no signs yet of a recession in that data. Unless that comes out extremely negative, I don't expect that to cause a lot of discrepancy. Friday, core PCE, this is a primary measure that the Fed looks at. They're expecting it to come down. This is an inflationary measure. If that doesn't come down as expected, again, that would be negative for the markets, and they might not react positively. Again, Michigan consumer sentiment, that markets don't pay a whole lot of attention to that. We'll look at earnings calendar while we're here. So again, investing.com, once you get to the economics calendar, you can also go to the earnings calendar very easily. We go to next week, should be winding down. We've got some biotechs, cruise lines. So again, it's always wise to pay attention to who's reporting, what sector they're in, how does that affect stocks in your portfolio, some gold, silver. So we'll see how that's translating to some of the miners. MD's asking about the M2 money report. I don't know offhand where to find that. If someone knows where to get the reference that's publicly accessible to that, if you'd please share that in the comments and the Discord, etc. I do know I was listening to some discussion, some other videos, Kathy Wood, Art Laffer, and some others, and they're talking about, M2 money supplies negative. We'll talk about some of the effects, again, of the banking crisis on in general. So again, you can go through again. Earnings should be winding down, but there's almost always somebody reporting, and it's always worth knowing who and what effect that may have on your portfolio, stocks you're looking to buy. Again, you can find the link to the earnings calendar in our notes. I'll also show you in Webull. You can see very easily what's coming up soon. Walter Lyons says Fred and Thinkorswim is an option to get M2. MD said he found it. Again, if you share that in the comments in our Discord, it may not let you post URLs in the live chat. So, okay, we looked at next week, the next FOMC meeting. Again, here's another place you can find the notes, the schedule. You got this link in the notes here, so you can see here's their meeting schedule, and also you can get their the PDFs, HTML for their statements. So that was another place I wanted to show you if you want to read their statements in more detail. Here's the press conference, etc. If you click on the link to the Federal Reserve, it's federalreserve.gov, etc. In their calendar, you can go back and see previous notes that have been released, as well as the calendar for upcoming meetings. So I hope that helps. Talked about earnings. Also, we have an earnings reports channel in our Discord with an automated feed. So I'll show you that real quickly. So again, join our Discord. It's free to join. Invites in the description box below. So as earnings news comes out, we have a link from this earnings news Twitter account. So it will automatically post to the earnings reports channel in our Discord. So you can see as earnings that might be pertinent to you come out. They'll come out relatively quickly in that Discord channel. So I'll quickly go over to Webull. We'll look at the market screen. Just a quick reminder, you can still get 12 free stocks from Webull. As you see, we do our market analysis, a lot of our due diligence, the majority of our trading in Webull. So if you're not already using Webull, we recommend it. Again, it's our favorite trading platform. And as you'll see, probably more so tomorrow, we particularly like the 4 a.m. to 8 p.m. Trading hours, as there's sometimes opportunities at that 4 a.m. Pre-market with some rebalancings, etc., that we like to try to take advantage of. So advancers decliners from Friday, we see more advancers, but the percentage is very small. So again, it just kind of eked out a little positivity. We'll probably see more in the NASDAQ, as I would expect. There's more inflow in the NASDAQ. Again, they're trying to, push tech. NYSE was pretty negative. Again, you can see the near-term earnings calendar in Webull on the market screen. This is the online browser version of Webull. So under calendar, you can see near-term earning calendar. So we see Carnival's before market open, anybody AMC after market close. Here's somebody during market hours. Let's quickly look at best performing industries for the week. So renewable energy is probably solar. So there's a Jinko Solar. I think that's a Chinese solar, Canadian solar. Some transports were positive, construction positive, education, semiconductors, E-Man, that's actually an AR/VR type company. We traded them in the past. Oil and gas, positive on Friday. Beverages. So pretty mixed. Consumer goods mixed. Berkshire at the top. Food and drug, coal positive. Again, we've talked about sector rotation in and out of coal. Containers and packaging. Look at the ETFs, look at the direction of the indices. So up on the Dow, up on the Russell, up on small caps. Again, Friday, everything, kind of turned positive towards the end. So right now we're pointing up. Bull 3x on the S&P, up on the S&P, down on the VIX. So SVXY, that's the leverage short on the VIX. So they're, expect the VIX to continue to go down. BITI is the Bitcoin short. So that being up says they're betting Bitcoin down. Russell up, small cap up. So again, as of Friday, they were betting up. Industries, utilities, again, we'll see that, flight to safety on Friday, environmental, aerospace, that's defense, couple defense, healthcare positive, energy mixed, communication services still positive. Again, utilities very positive, technology, that's showing more negative. So, possibly a downtrend coming in technology, basic materials, miners, lithium miners, water. So that's interesting. Consumer cyclicals negative. Again, energy mixed. Consumer defensive, again, defensive. Real estate, you can see the positive sector rotation now into real estate. See REIT, that's general REIT. There's a bank ETF they made, rotated into. We'll talk about the risks, and we've talked about that with the banking collapse. Carbon, we've seen that be positive. We're going to talk about wheat tomorrow. This ETF in particular, again, I'm getting interested in agricultural. That's one I want to talk about and look at in more detail tomorrow. Nickel, so basic materials, coffee, again, some commodities, softs, cotton, etc. Bonds will be kind of interesting. Asia, 7 to 10s, 3 to 7, so short end of the curve, and then the very long end of the curve. Yen, negative. Swiss franc, pound, negative. So dollar strength. So let me grab a drink and let's look at the futures. Check the comments. You might talk about CDs. Yeah, we'll talk about money markets, etc. Okay, so if we look at the futures, we see, Dow's got a hammer showing here, so that's kind of positive for the Dow. You see these long wicks, so a lot of volatility. S&P very similar. Again, a lot of volatility, a lot of long wicks, a lot of volatility back and forth. So I would expect, continued choppy, pretty much range bound with a lot of volatility. NASDAQ did break out again. I think that's strengthened the FANGs, the Megatex, NVIDIA, etc. If those start to deteriorate, I think, potential downside in the NASDAQ. Russell, again, been getting beat up. A lot of volatility, broke down. It looks like it's very near the previous bottom, and potential downside if that breaks down further. Again, the VIX very choppy. We see these very long wicks. So we get on these events, the bank collapse announcements, etc. We get these big pops in the VIX, these very large bars, and then we see a deterioration, a rotation back down. So right now, mid 20s, so the VIX is pretty much stuck there. So I don't see a lot of opportunity again, either way, long or short in the VIX. We'll talk about this in more detail tomorrow, but of course that's all dependent on news. If we get something that really scares people, then we'll get a pop in the VIX. You see this oil, tested 70. 70 is now acting as resistance, so it got rejected off of 70. The lowest point was, around 65-ish. So again, very long wick. So when it touched back down there, it bounced back pretty quickly. And again, when it hit 70, it rolled over. So we heard part of the news with oil is the administration came out, and I don't know what the issue really is, but they said they wouldn't even be able to refill the SPR this year. People were counting on that to put a floor into oil. Part of that announcement then caused, a breakdown in oil. So, I would expect further, the oil companies, OPEC, etc. They want higher oil prices for their profitability. So we may see a decrease in supply to keep oil prices at least steady. But I don't know if we'll see a major run up or run down in the near future. Again, natural gas, once it hit 3, it got rejected, bounced down, right? Looks like it's trying to form a new bottom above the previous 2. 2 was the previous bottom it bounced off of. I kind of expect it's going to be kind of stuck in this range until we get some other catalyst to propel it. Again, I think 3 is a resistance. I think 2 is a support. So I would expect, it to bounce back up to 3, retest 3, and probably get rejected again unless we get a catalyst and some volume to move it. Again, we see this resistance in gold at 2,000. Gold's very strong. Again, flight to safety. Part of this is the fleeing, out of the bank. So part of where people are putting their money in perceived, safety is in gold, silver. And we'll talk about some other areas as well. We'll see in treasuries the effect it had on treasuries as well. So we see, again, I expect gold's been trying to break out of 2,000. It's been eroding that resistance. Once that resistance finally gets eroded and it makes a strong push through 2,000, might go up. I think the previous high was about 2075. And it may continue given this, flight to safety, fear from the banks. So silver, I think, is a better opportunity just because it's got more range to run up. I think the previous high in silver was somewhere around 30. So again, I think there's more positive opportunity in silver. You see it's still running up. It's got some room to run up at least into the 24s, a little below 25, and then even further to 30. So again, I think there's more upside potential in silver. Again, as most of you know, we have had sizable positions in gold and silver for a long time. If it does approach those previous tops, we'll look at exiting those positions. We've been watching palladium. It's been kind of bouncing up and down. This looks like it's oscillating, forming a new steady state. We'll talk about that as well. So then all the commodities, and again, I want to talk about that in more detail tomorrow. We see the spike. The spike was when Ukraine came out and said their harvest was going to be 10% less. Again, I want to talk about some other potential catalysts relative to agricultural products, particularly in wheat. So I think there's some opportunities in this area in general as we're now in spring. And then we see this effect of flight to safety on bonds, which again, in my humble opinion, is irrational. But it's when people are afraid, they're afraid to leave their money in the bank. A couple places they flee is gold, silver, and bonds. So they take their money out of the bank and they buy treasuries. They feel that that's more secure possibly than their deposits in the bank. So we see this wild run up in treasuries, and when the prices of treasuries goes up, the yield goes down. So we saw the yields push down in the low threes. So now you're getting less in a treasury than the Fed is charging in their interest rate. So that doesn't make a whole lot of sense. But again, it's just pure flight to safety. Also with the foreign banks having issues, Credit Suisse, Deutsche Bank, etc. I wouldn't be surprised if there's not a flight from foreign bonds, foreign currencies into U.S. Treasury bonds. It's seen, as a safe haven. So I expect this to eventually correct as the fear eventually abates and prices to drop, yields to go back up into the 4 range again to compete with the Fed interest rates. Again, we saw the dollar strengthen. Again, more a flight to safety, fear, flight into the dollar. So we saw the dollar strengthen a little bit. And the yen, typical, flight to safety currencies, U.S. dollar, Japanese yen, impacts the euro, etc. So again, the message being we're seeing a lot of cases of fear, flight to safety, although again, the VIX isn't showing that within the stock market. Okay, so some more news. A lot of events, a lot of news. I'm trying to get through as much content as possible. Hopefully this all helps. Again, you can read these articles via the links in our notes, but some that I thought were notable. Walmart laying off workers at 5 fulfillment centers. To me, that says they're seeing a coming decrease in demand. And Walmart obviously is a low-end retailer, so this is an indicator, what they call a canary, as a potential looming recession. Because if the low-end retailers laying off, they're expecting a decrease in demand. Accenture is a high-end consulting firm, and they're cutting workforce. Their revenue is directly related to billable hours, and that says, okay, companies aren't buying their high-end consulting services. I expect other consulting companies to also start cutting. So anybody that's dependent on enterprise level consulting or professional services, I would expect them to start cutting. So now it's not just the tech companies we're seeing cutting, it's the ones that service those companies, consulting firms, and also, retailers. So again, I would expect more. And here's a article that says the Fed sees a recession later this year. So again, in my humble opinion, I see these as all indicators of a coming recession. We don't have the data to support that we're in a recession. We don't know when that will occur. And even the GDP data that we're going to get this week, that's for fourth quarter last year. It's not really going to tell us when we could expect to see a recession. But again, I see these as indicators that it's coming. So we're going to plan and trade accordingly. Here's the link to the news article where Ukraine said their harvest was going to be 10% lower this year than last year. So again, we'll talk about that and the potential impacts of that and how we can potentially trade that more so tomorrow. Yes, that's part of my point. Ollie in the Bay says the layoffs are just starting. And again, that was my point, and now it's propagating to other industries, not just tech. It's those that service the tech and also just the general consumer. So yeah, I expect we'll see a lot more in the near future. So let's very quickly talk about some of the impacts from the latest Fed interest rate hike. And again, strategies, how we can trade this, how we can be successful, make money in our trading. This along with, again, the collapse of the banks, we would expect, again, this is going to exacerbate some of the issues with the banks. Again, we saw, although they ran the prices up in bonds due to the fear of the flight to safety, when those yields correct, it's going to exacerbate the problem when those bond prices drop again. And also, we're seeing people are pulling money out of their banks and putting them in money market funds because now the Fed raised interest rates. So now money market funds and treasury bonds, again, we talked about the yields in treasury bonds need to correct, but as they do, those become safer, more attractive alternatives to stocks or even in this case, money in the bank. So again, I would expect to see continued outflow of money from banks, from stocks, I should say, and stocks, to, money market funds and treasuries. Um, Also, you heard Powell talk about tightening credit, obviously higher interest rates, and also the banking issue means there's going to be higher credit card rates, higher mortgage rates, higher auto loan rates, and decreased spending in those areas, and potentially more defaults in those areas just because of the tightening credit, the higher interest rate, as those start to hit. They're not going to be offering credit as readily. It's going to be at a high rate. And those that already have those, and if it's adjustable, you're going to see more defaults. And again, as the mortgage rates go up to compensate for higher interest rates, you're going to see less new buyers in homes, and also a decrease in existing home supply because anyone with a lower rate mortgage isn't going to be willing to sell if they have to take a mortgage and for their new home at a much higher rate. So again, existing home sales will probably decline. So we've been talking about the bank collapse for a couple weeks. We've released several videos with our strategies relative to, not getting trapped, not getting hurt in these bank collapses. We started with Silicon Valley Bank and Silvergate, and then last week we talked about Signature. Now we've got Credit Suisse. We've got issues with Deutsche Bank. So again, this is an ongoing issue. This again seems to be causing the most volatility, the most fear in the markets. I do not know. I don't watch general news very much, so I don't know how this is propagating the populace. I know my mother hasn't called and asked if she should pull her money out of her regional bank yet, so maybe the population hasn't caught on to these issues, but there is a massive outflow of money from regional banks into the too big to fail. So one of the things I was going to comment, massive outflow of deposits from regional banks into the few large too big to fail banks, into money markets, into treasuries. And again, we talked about that when they, flee into treasury bonds, that drives the prices up and drives the yields down, which is contrary to the rising interest rates. So Walter says his mother called. So, yeah, like I said, I'm not sure how far that has propagated into the population yet, but as it does, and people get scared. We talked about this, for a couple weeks now. They're going to be pulling their money out of these regional banks. They'll flee to. Easy Mike talked about CDs, money markets, treasury bonds, etc. And what part of what that does is that pulls money out of the money supply. Also gold, silver, and into their mattress and under their floorboards. So some other implications and things we want to be aware of is they talked about this backstopping, bailing out the banks is going to cause an increase in FDIC insurance costs. So that means higher banking fees and potentially higher costs to consumers, which means less profit for banks, which means they may cut their dividends. So another risk with some of these banks is if you're in a bank stock for its dividend, they may have to cut if they are earning less profit. So something to be aware of. Another thing that these consolidations is as these bigger banks or other banks buy these failing banks, Often in our area, we can go down one street and there's like 3 or 4 different banks. Well, if they consolidate, they don't need both branches. So they're going to close one of those branches, which means that real estate becomes available, right? It also means those employees are redundant. I don't need tellers at 2 branches if I only going to have one branch. Also, if I'm under pressure with assets, etc., costs, do I need as many branches? Well, maybe I'm going to close some. And again, that increases commercial real estate supply and lays off more people. So again, things to think about in this commercial real estate area is one of the areas, that's at risk right now, as due to this, the higher mortgage rates, etc. We're not interested in commercial real estate right now. So I'm running out of time, but I want to, we want to think about who's next. Obviously, other regional banks are at risk. Other global banks are at risk after Deutsche Bank. Who's next? I've also heard comments of insurance companies. Insurance companies, they invest your premium. That's how they actually make their money. It's not off the premium you pay it. It's the money they make from investing that money. That's why they don't want to pay it out until they absolutely have to, because that's how they make their money. Again, we're not trying to cause a bank run or anything like that, but make sure these banks could get, closed, halted. Again, talking about trading these banks, we're not going to touch them. Too high a risk. There's a risk they could get halted. You can get stuck when they halt if they end up getting closed. We're going to stay away from that. Any of that risk, we don't recommend it. So again, not financial advice, but please be careful. We don't want to see anybody get stuck, anybody get hurt in this. So I'll leave these notes so we can talk about this maybe more tomorrow. But I did pull a number of our videos that have to do with how to play sector rotation. We talked about this. This is where I think we have an opportunity. We saw how choppy the markets have been, how range bound they've been, but how money is rotating. We talked about rotations in and out of solar, in and out of coal, in and out of aluminum. I think if you watch the sectors during the day, see where the money is flowing out of and into, I think there's good opportunities to make money trading these sector rotations. So again, we have a number of previous videos that you can use to help you make money trading sector rotation. And again, you can use our ETF Google sheet. We have a sectors sheet in there so you can see which sectors are moving. Our all access and BIP Patreons have 24/7 access to that whole spreadsheet, and you can also find ETFs to play various sectors and industries within sectors, etc., using that Google sheet. And we'll look at that more tomorrow. I need to cut this off before an hour, so if anyone has any questions, again, tomorrow we'll talk about ETFs, dividend payers, option strategies. I'll look at these additional ETFs that Easy Mike mentioned. I believe they're ETFs. And if anyone else has any questions, you can post them in the comments to this video in our Discord. Again, our Discord's free to join. We also have a Facebook group. You can post comments, questions there. You can find links to our Facebook group. You can also contact us directly via social media, and all these links are on our homepage, beachbumtrading.com, bum without the U. So you can find links to our Discord, Facebook group, all our social media on our homepage, so you can ask us questions, make comments, etc. And we'll try to respond as soon as we're able. So sorry for the rush. We had a lot of material to cover. Again, I'll try to cover more of it tomorrow. I hope it all was helpful. Please, again, let us know in the comments. I hope you like this content. Please let us know. We'd love to hear your comments in the comments below the video. We'd love to see you in our Discord, join our community, and we can continue these conversations in those forums. Thank you to everyone that joined us in the live chat, and I hope to see you all again tomorrow, 10 a.m. Eastern Time. We'll cover part 2, talk about our individual stocks to put on our top swing trading watch list. We'll talk about ETFs, options, dividend payers, etc., and additional strategies and trading ideas to help you succeed in your trading career and make money and survive the impacts from the latest Fed interest rate hike and the ongoing bank collapse. So thank you all for watching and have a great day.